Welcome. Today we'll be looking at 5 stocks which are trading near their 52-week lows in February 2025. So let's start off with Restaurant Brands International, ticker symbol QSR, which is a company which operates in the fast food industry. Now this stock is down over 19% in the past year, and it is of course at the lowest point it has been in the past 12 months. And this can be seen when we look at their valuation ratios, where not only their price to earnings ratio has fallen and is currently at around 17 times, but their price to cash flow ratio has also fallen and is currently at around 22 times, the lowest both these metrics have been in the past 12 months. Now the main appeal that this company has is their dividend. They currently offer a 3.6% dividend yield, which they have been able to maintain for a long time. However, when we look at their 3-year dividend CAGR, it's a mere 1%, which means that since COVID-19, they have been finding it hard to grow this dividend and reward shareholders. However, when we look at their financials, we can see that their total revenue, gross profit, and net income have been increasing in 2024 since the first quarter all the way up to the third quarter. The great thing to see here is that their margins have been rock solid. Of course, their net margin has decreased a little bit, but it doesn't look like it is anything too worrying. Now, another very positive thing is that if we look at their free cash flow evolution, since the first quarter of 2024, it has risen at a very fast pace and it looks extremely predictable, which is something that we love to see. And finally, when we look at their balance sheet, yes, their liabilities have been increasing slightly, but their total assets have been increasing at a similar pace, which has allowed their current ratio to stay pretty solid. Now moving on to stock number 2, Vici Properties. It's in the real estate industry, and we spoke a lot about this company prior to July 2024. Now the main reason for the price movement that this stock has suffered has to do with interest rates. Of course, since this business operates in the real estate industry, it benefits a lot from low interest rates, because this means that their interest expense will be lower, and this is generally one of the largest expense that these type of corporations usually face. Historically, it looks like Vici has a very low valuation because it's not considered a growth stock. It has had a PE ratio at around 13 times and their price to cash flow ratio a bit higher, at around 14 to 15 times. When we look at their juicy 5.73% dividend yield, this is where this investment starts to become attractive. It's not a growth stock, it's more of an income play. And since in these past 3 years interest rates have been pretty high, they have not been able to grow their financials at the rate that many investors wanted them to do so. This is why their 3-year dividend CAGR is a mere 3%, but I believe that this company can do much better if we see a low interest rate environment again. And when we look at their financials, we can see that this company is synonymous with predictability. Their revenues, their gross profit, and their net income are rock solid, they're very predictable, and very stable. Of course, since it's a REIT, they have very low costs, which is why they managed to obtain a net margin of around 80%. And this is a very common dynamic of this sector, because some of the only expenses that they face is administrative expenses or interest rate expenses. However, when we look at their free cash flow generation, we can see that it is extremely predictable, very stable, and it has been growing if we compare the past 12 months, which is a positive sign. Finally, when we look at their balance sheet, we can see that their total assets are way above their total liabilities, which brings their current ratio to a very solid level. Now moving on to company number 3, we have none other than Novo Nordisk, ticker symbol NVO, and this company is in the healthcare industry. We can see that recently this company has been hammered down since July 2024, but last Friday alone, this company was up around 8% on positive news regarding some of their other products in the pipeline. Now, Novo Nordisk is regarded as a growth stock, but as a very high quality growth stock, and this can be seen by their valuation ratios, which peaked at a P/E ratio of around 50 times and is currently sitting around 40 times. Another way to see this growth is by looking at their dividend increase. We can see that since 2020 all the way up to 2022, they had been growing their dividend at a fair pace. However, in 2023, due to record profitability, they increased this revenue at a massive amount, currently yielding a 1.17% dividend yield. And if we look at their 3-year dividend CAGR, it amounts to 23%, which is incredible. And the fact is that this company has been growing steadily and is extremely profitable. Their margins have gone up, if anything, but have been trading at around similar levels, with their net margin currently sitting around 40%, which are incredible numbers. Now we can also look at their free cash flow evolution, which they have been focusing on improving in the past quarters. We can see that in the first 2 quarters shown, they weren't actually generating much because they were investing a lot into R&D, CapEx, and other type of expenses to grow their business further. However, in the latest 2 quarters, they started to, first of all, increase their dividend and also started to want to reward shareholders. And finally, when we look at their leverage evolution, yes, their liabilities have increased at a fast pace, but their total assets have increased at a very similar pace as well, maintaining or even improving their current ratio. Company number 4 is Evolution Gaming, and we've spoken about this company in the past, but recently I have seen a lot more videos and a lot more interest about this stock. It's in the gaming industry, and it is obviously undervalued. However, there is a reason to this. Recently, there have been a lot of short reports on the stock. These imply that they may lose their licenses, that they have been involved in fraud, and other type of accusations. Of course, there is no way for us to know if that is true right now. Since investors don't want to take that big of a risk, they have stayed away from the company. This is why it is currently down over 30%, but it's gotten to the point where it may actually be attractive. With a P/E ratio of around 16 times and a dividend yield of 2.5% with a 3-year dividend CAGR of 45%. We do have to consider that they were recovering from the pandemic where they decreased their dividends, but it's still a very impressive growth rate. And the fact is that this company has incredible financials. Their revenue is very predictable, it's very consistent, and it's very well divided across the different quarters. And their margins have expanded recently. However, even if we look at their lowest net margin in the past 12 months, this has been a 53%. And this is extremely rare to see in such a hammered down company. It still gets better because look at their free cash flow evolution. They have not missed a beat, and every single quarter they have delivered incredible free cash flow, extremely predictable and very stable, which is a great combination. And finally, when we look at their balance sheet, they barely have any liabilities, and they have over 4 times their total assets than their total liabilities, implying that this company won't have to worry about debt anytime soon. So this company looks amazing. I will actually have to do a deep dive and research all of the short seller reports, because at these levels, the risk to reward may actually be there. And last but not least, we have Constellation Brands, ticker symbol STC, which is in the beer, wine, and spirits industry. Now this company recently got hammered because of an earnings report, and you can see the drop right at the beginning of the year, currently down over 25%. When we look at their valuation ratio, we can see exactly what happened. This company's profitability lowered significantly starting in Q2 2024, and this is why their price to earnings ratio increased so much, but historically it has been trading around 25 times. This company is paying a 2.14% dividend yield, which has been growing at a 3-year dividend CAGR of 6%. Not bad, and it looks like stable, consistent growth. But when we look at their financials, we can see just what I was talking about. Yes, their total revenue had been growing until the latest quarter, Q3 2024, which is one of the main reasons behind the stock price drop, but we can also see that horrible net income figure in Q2 2024, which affected the rolling net income and increased heavily that price to earnings ratio. Now we could say that this company's margins have been extremely stable, and they have been, but we would have to ignore that Q2 2024. So before actually doing more research on this company, I would suggest to investigate what was the main reason behind that great loss. Now, despite them having a negative net income in the quarter, they still had a very positive free cash flow quarter. And now, finally, when we look at their balance sheet, it looks like, yes, their total liabilities have been staying put, but their total assets have been decreasing, which has actually worsened their current liabilities. Now, before we move on, all these graphs have been made with TradingView, and there is a link down below for a discount if you join using that link. Now, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.